Hey traders, what's going on? Jamie Saettele here with SB Trade Desk, and I want to take a look at the Japanese yen. It's just something that I can't hold back any longer. I got to get it off my chest. We've been talking about this comparison with the mirror image of the late 80s, early 90s for quite a while. Um, and if you want to read about that, just go to the long-term page, and you can see the comments from back in August and whatnot. But I want to dive into the chart here and get a little more detailed on it. So just a quick review and why we think this is the case. So it's really all about the picture. You have this strong decline into the late 80s, just as you had this strong rally into 2015. Those are the opposite situations, okay? Well, then you have a big, corrective advance, just like you have a corrective decline. Okay, then you have the next leg higher currently within what is an ongoing uptrend, or that's the idea. So this part here, what just happened from 2015, June, the Brexit low essentially, up until just recently, December 15th or January 2nd, first trading day of January, if you want to, whatever you want to call it, the highs are essentially the same. These highs are analogous to these lows, just like the highs back in 1990 is analogous to the lows back in the summer. So what we're going to do is compare price action on the chart, because price doesn't lie. We can have all the opinions we want, but price does not lie. The picture does not lie. When I do comparatives, I like to compare what I call the maximum point of emotion. And there's a couple on this chart. You could say Brexit is obviously one of them, but so too would be the August 15th or August 2015, crash, if you will, right? There was a lot of things happened that day. If you recall, you look back at the charts, you actually saw that was the low for a lot of commodity things. You had the low in kiwi, you had lows in a number of big commodities, you had lows in a number of crosses and tops of a number of crosses that were commodity based. So we're going to point out this as the maximum point of emotion. We're going to compare it to the spike high on the week back here in 1989, which was, I believe, in June. And let's, for a moment, just forget about total differences in macro scenarios and just remember that human emotion is constant, right? The actors are different, but the emotions of those people really are the same. So what we're going to do is we're going to compare this to price action back here, but we got to make it the mirror image, right? This is a really cool thing about TradingView, by the way, is you can do this. So we're going to match that up there. Now you see what happens. You get a pretty good match, especially with the timing of it. You have a low, some sideways. The next big turn is right on Brexit. The next big turn says that it's basically now, okay? And that we're right here. So with this, it's worth taking an even deeper look. So we're going to take an even deeper look. We're going to look at daily bars now. So we're going to look at daily bars from over 30 years ago. Well, not quite 30 years, I guess. We're looking at, where are we looking? Oh, we're looking here. 28 years ago. All right, so we're looking here. We're saying that this low in 1990 is analogous to the high that was just registered in either December 15th or the first trading day of January, whatever you want to put it at. Essentially the same thing, but we're really going to match it up to the first trading day of January. And again, we gotta mirror image it, right? Mirror image. All right, we're going to match that up, and lo and behold, look what happens. It's you know, for the most part, I mean, you could say it's kind of calling it, right? So look, do I know if this is going to continue? Of course not. I have no idea, right? I don't know if this is going to resume or not. But given our analysis that we've been doing over the last couple of days and weeks with the short-term patterns, and also given the fact that you have just kind of understanding, you know, the sentiment right now, the situation, it's hard to find a neutral person on dollar yen right now. Everyone's either thinks that this was the dip and that we're going to go to the moon, or that this thing's going to crash. So it would not be much of a surprise then, given those thoughts, if we actually just kind of went sideways for 3 or 4 weeks, which is actually what this comparison kind of suggests. So, you know, don't get me wrong, the next trade I think is probably on the short side, right? We're looking at 116, wrote about it earlier today in the swing update is the big spot. But then once you might get a retest of the lows. And you know, we start to get down there, be nimble and don't get married to the short side, because at that point we could go drifting. But the bigger thing to take away from this, I think, is that, you know, we could very well be in a situation in 2017, like, you know, it could look like this. It really could. You know, I'm not saying it's going to match this perfectly. That'd be nuts. Although it would be pretty cool. Um, but yeah, we could be in a drift, you know, lower. We could have some big drops and big rallies. You know, we could be in a drift lower throughout the year, and then finally make what would be essentially the corrective low of this rally at some point very late in the year. So I'm going to leave it at that. But this is food for thought and something that's, you know, I've been thinking about for a while, and I thought it was a good time to kind of publish it, just given what's going on with the pattern and the fact that the short-term stuff seems to be matching up pretty well. So hope you enjoyed the video, and I'll sign off here. Jamie Saettele with SB Trade Desk. Take care. Good luck.